Welcome, Apex Financial Group. Today, we're covering the basics of fixed index annuities, also known as FIAs, and how they compare to indexed universal life insurance, or IUL. If you already understand how IUL policies use market indexes for potential growth, then you'll notice some similarities with FIAs. Both products allow clients to benefit from index-linked interest opportunities while protecting principal from direct market losses. However, there are important differences between the two products. One of the biggest differences is the interest crediting potential. Fixed index annuities generally offer lower caps and crediting rates compared to indexed universal life policies. Why is that? The reason comes down to time horizon and investment strategy. With life insurance, insurance companies expect many policyholders to keep their coverage for decades, often for the rest of their lives. Because of that long-term commitment, carriers can structure more aggressive crediting strategies and potentially offer higher caps. Annuities work differently. Most clients typically hold annuities for around 7 to 12 years before transferring, repositioning, or using the funds. Since the money usually stays with the carrier for a shorter period, insurance companies use more conservative strategies when determining interest crediting rates. In this training, we'll walk through how fixed index annuities work, how indexing and interest crediting are calculated, the key differences between FIAs and IUL products, important factors to consider when helping clients choose the right solution for their financial goals. By understanding these concepts, you'll be better prepared to explain annuity strategies clearly and confidently to your clients. Introduction to Fixed Indexed Annuities. Welcome, everyone. Today, we'll learn about fixed indexed annuities, or FIAs, and how they can help clients protect and grow their retirement savings. FIAs are similar to indexed universal life, IUL, because both use market indexes to determine interest growth potential. However, FIAs are designed with a stronger focus on retirement protection and steady accumulation. Key difference between FIAs and IUL. One major difference is the potential for crediting. IUL policies are often kept for a lifetime, allowing insurance companies to offer higher caps and long-term growth opportunities. FIAs, on the other hand, are typically held for 7 to 12 years. Because of the shorter time frame, insurance companies use more conservative crediting strategies, which usually result in lower caps and participation rates. Benefits of fixed indexed annuities. Protection from direct market losses. Opportunity for index-linked growth. Tax-deferred accumulation. Reduced market volatility risk. Long-term retirement planning support. What we'll cover today. How FIA indexing works. How interest is credited. Differences between FIAs and IUL. Strategies to help determine the best fit for clients. Let's get started and learn how FIAs can support smarter retirement planning solutions for clients. What is a fixed index annuity? A fixed index annuity, or FIA, is a financial accumulation product issued by an insurance company and designed to help clients grow and protect their retirement assets. FIAs earn interest based on the performance of a market index, such as the S&P 500, while keeping the client's money protected from direct market losses. How FIAs work. Client funds are not directly invested in the stock market. The insurance company keeps funds within its general account. A portion of the earnings is used to purchase market index options. These options allow clients to benefit from index-linked growth potential. Because the principal is not directly invested in the market, clients are protected from stock market downturns. Important features: principal protection from market losses, opportunity for tax-deferred growth, interest linked to market index performance, multiple crediting strategies and methods available, designed to support long-term retirement planning goals. What we'll cover next. In this training, we'll review how index crediting methods work, different participation and cap strategies, how insurance companies calculate interest, key concepts to help determine suitable solutions for clients. Before we continue, it's important to understand the foundation of how FIAs provide both growth potential and protection. Understanding FIA crediting terms. Important FIA crediting concepts. Before discussing fixed index annuities in detail, it's important to understand some of the key terms used in annuity crediting strategies. One of the most important terms is the cap rate. What is a cap rate? A cap rate is the maximum amount of interest a client can earn during a contract year under a specific crediting method. For example, if the cap is 10% and the market index grows by 12%, the annuity would be credited up to the 10% cap. How interest rates affect caps. Cap rates are heavily influenced by overall interest rates. When interest rates are lower, insurance companies have less money available in their general accounts. This limits their ability to purchase market index options. As a result, cap rates are usually lower. When FIAs were first introduced in the early 1990s, interest rates were significantly higher. During that time, some annuities offered higher participation rates, uncapped strategies, greater growth potential. However, those products are far less common today because today's economic environment is very different. Important compliance reminder. It's extremely important to use accurate language when explaining FIAs to clients. Fixed index annuities do not provide direct market returns. Instead, clients participate in a portion of the market's upside potential while being protected from market downside losses. A better way to explain FIAs is FIAs offer growth potential linked to market performance without direct exposure to market risk. Avoid saying market returns without risk. Stock market returns guaranteed. These statements can create unrealistic expectations and may not accurately describe how FIAs work. Key takeaway: FIAs are designed to provide principal protection, index-linked growth potential, reduced market risk, more stability than direct market investing. Understanding cap rates and crediting strategies is essential when helping clients choose the right retirement solution. Understanding fixed indexed annuity participation rates and monthly averaging participation rate. Another important concept in fixed indexed annuities is the participation rate. The participation rate determines how much of the index growth is credited to the annuity contract. Example: if an FIA has a 40% participation rate and the market index increases by 10%, the annuity would receive interest based on 40% of that gain. In this example, the credited interest would be 4% before any additional limits or adjustments. Participation rates allow clients to benefit from a portion of the market's upside while still protecting their principal from market losses. Monthly average crediting method. Another common crediting strategy is called the monthly average method. With this approach, the insurance company tracks index changes each month. Monthly gains or losses are averaged over the contract year. The final average helps determine the amount of interest credited to the annuity. This method is designed to smooth out market fluctuations over time instead of relying on a single measurement date. Key takeaways. Participation rates determine how much index growth is credited. Monthly averaging uses multiple monthly measurements during the year. FIAs provide market-linked growth potential with downside protection. Different crediting methods can impact long-term annuity performance. Next, we'll review these strategies in greater detail and discuss how they may fit different client goals and risk preferences. FIA crediting strategies: caps versus uncapped participation fixed account option. Many fixed index annuities include a fixed account that guarantees an interest rate for a 1-year period. In today's environment, guaranteed rates of 2% or higher are generally considered competitive. This option can provide stability and predictable accumulation for conservative clients. Participation rate strategy. With a participation rate strategy, clients receive a percentage of the market index gain. Clients are protected from market losses. If the index declines, the credited interest is typically 0%, not negative. Example: uncapped participation. S&P 500 gain 20%, participation rate 40%, credited interest 8%. Because there is no cap, the client can continue benefiting from strong market years based on the participation percentage. Capped participation strategy. Some FIA products offer 100% participation rates, but include a cap, often between 4% and 6%. Example: capped strategy. S&P 500 gain 20%, participation rate 100%, cap 5%, credited interest 5%. Even though the market gained 20%, the client only receives the capped amount. However, in smaller growth years, if the index gains 3%, the client receives the full 3% since it remains below the cap. Comparing the strategies: uncapped participation, better potential during strong market years, may capture more upside over long periods. Lower participation percentage. Capped strategies, full participation up to the cap, may perform better in moderate market years. Growth is limited during high-performing years. Important planning perspective. Since FIAs already protect clients from downside market losses, many advisors focus on maximizing long-term upside potential whenever possible. Over a 7 to 10-year period, strong market years can significantly impact overall growth. Uncapped strategies may provide greater accumulation opportunities over time. Lower caps can reduce long-term growth potential. Key takeaways. FIA clients participate in market gains without direct market losses. Caps limit maximum credited interest. Uncapped strategies may offer stronger long-term growth potential. Different strategies fit different client goals and risk preferences. Understanding these options helps financial professionals better educate clients and build suitable retirement income strategies. Monthly average crediting and FIA bonus features. Monthly average crediting method. The monthly average strategy is a common FIA crediting method that measures index performance throughout the year instead of relying on a single annual point. How it works. The insurance company tracks monthly changes in the index, such as the S&P 500. Monthly gains and losses are added together. The total determines the annual credited interest. Example: if the index experiences plus 2% in January, plus 2% in February, minus 3% in March, additional monthly gains and losses throughout the year. The final combined result may produce a positive annual credit, such as 5%. Benefits of monthly averaging: helps smooth out market volatility, allows clients to benefit from multiple positive market months, provides downside protection during negative market periods, can produce stronger returns during consistently positive market environments. In strong market years, monthly averaging strategies may generate higher credited interest compared to some capped methods. Over longer periods, many monthly average strategies may average approximately 5% to 6% annually, depending on market conditions and product structure. Understanding FIA bonus features. Some FIA products offer upfront bonuses, enhanced starting values, additional credits added at the beginning of the contract. These bonuses can appear attractive because clients may immediately see an increase in their account value. Example: a carrier may offer 5%, 7%, or even 8% upfront bonus credits. Important trade-offs. While bonus products can be useful in certain situations, they often come with lower participation rates, reduced long-term growth potential, more restrictive crediting structures. Because of this, bonus products may produce lower long-term accumulation compared to uncapped strategies with stronger participation rates. When bonus products may make sense. Bonus-focused products may still be appropriate for certain clients, especially when immediate value enhancement is important, estate planning goals exist, the client has health concerns or shorter time horizons, wealth transfer strategies are a priority. Suitability always depends on the client's goals, timeline, and financial objectives. Long-term planning perspective. For long-term accumulation strategies, higher participation rates often outperform large upfront bonuses over time. Uncapped growth potential may create stronger long-term results. Clients should understand the trade-off between short-term incentives and long-term performance. Educating clients on these differences helps build realistic expectations and better retirement planning decisions. Key takeaways. Monthly averaging measures index performance throughout the year. FIA bonuses can increase starting account values. Bonus products often reduce long-term participation potential. Higher participation strategies may offer better long-term growth opportunities. Product selection should always align with client goals and suitability needs. Understanding fixed indexed annuity bonus recovery periods. How fixed indexed annuity bonuses really work. Some fixed indexed annuities offer large upfront bonuses to attract investors. While these bonuses may look appealing, it's important to understand how they actually work. In many cases, the bonus is not fully vested immediately. Simple example: a client invests $100,000, receives a 10% bonus. Starting account value becomes $110,000. Sounds attractive at first. However, if the annuity has a 10-year surrender period, the client may only earn ownership of 1% of the bonus each year. What happens if the client withdraws early? If the client cancels or withdraws funds before the surrender period ends, they may lose part or most of the bonus. The insurance company can reclaim unvested bonus amounts. Surrender charges may also apply. Example: if the client exits after 1 year, they may only keep $1,000 of the original $10,000 bonus. The remaining bonus could be forfeited. Why participation rates matter more. Large bonuses often come with lower participation rates, lower long-term growth potential, more restrictions inside the contract. Because of this, many long-term investors may perform better with higher participation rates, uncapped growth options, stronger long-term accumulation strategies. When bonus products may be appropriate. Bonus annuities may still make sense in certain situations, such as poor health cases, estate planning needs, wealth transfer strategies, clients unlikely to access the money during the surrender period. Suitability always depends on the client's financial goals and timeline. Key takeaway: large upfront bonuses can be attractive, but often come with trade-offs. Early withdrawals may cause clients to lose much of the bonus. Higher participation strategies may provide stronger long-term growth. Always evaluate the full contract structure, not just the upfront incentive. Understanding FIA income riders. What is an income rider? An income rider is an optional feature that can be added to many fixed index annuities for an additional annual fee. Its purpose is to guarantee future lifetime income or a guaranteed annuity value at a future date. Simple example: a client invests $100,000, adds an income rider. The insurance company may guarantee that in 10 years, the client can receive a certain monthly income for life or have a guaranteed annuitization value for income calculations. For example, guaranteed lifetime income of $3,000 per month or a guaranteed income value of $200,000. At that point, the client may choose the actual accumulation value or the guaranteed income benefit. Important considerations: income riders usually come with annual rider charges, reduced accumulation potential, long-term commitment to one carrier. Example: if the rider fee is 0.75% annually and the annuity earns 5%, the net growth becomes approximately 4.25%. Over many years, those fees can significantly reduce overall accumulation. Why flexibility matters. Without an income rider, clients keep more flexibility. Advisors can compare multiple companies later. Better annuitization options may be available in the future. Different insurance companies may offer different payout rates, different lifetime income amounts, different annuitization calculations. Even small differences between carriers can create meaningful changes in retirement income. Planning perspective. Some advisors prefer focusing on long-term accumulation first, reviewing options over time, choosing the best income solution closer to retirement. Instead of locking into one company today, the strategy is to grow the assets efficiently, reevaluate income needs later, select the strongest income option when retirement begins. When income riders may be useful. Income riders can still be appropriate for clients who want guaranteed future income, prefer predictable retirement planning, value guarantees over maximum growth potential, need additional income security. Suitability always depends on the client's goals, risk tolerance, and retirement objectives. Key takeaways. Income riders provide future lifetime income guarantees. Riders usually include annual fees. Fees may reduce long-term accumulation growth. Income riders can limit future flexibility between carriers. Comparing income options later may provide stronger retirement outcomes for some clients. Fixed indexed annuity care waivers and future income planning. Future income guarantees and interest rates. Some fixed indexed annuities allow clients to lock in future income guarantees through annuitization or income features. However, it's important to understand that these future income calculations are based on today's interest rate environment. If interest rates rise in the future, better income payout options may become available later. Planning perspective. Some advisors prefer maintaining flexibility rather than locking into today's rates for decisions that may happen 10 years from now. This approach allows clients to review future market conditions, compare multiple companies later, potentially access stronger payout rates in the future. Confinement care and nursing home waivers. Many FIA contracts include care-related waiver features. These provisions may allow clients to access funds without surrender charges if they enter a qualified care facility or experience certain health conditions. Typical trigger requirements. Depending on the contract, benefits may activate after 60 to 90 consecutive days in a qualified care facility or inability to perform 2 out of 6 activities of daily living, ADLs. Examples of ADLs include bathing, dressing, eating, mobility, toileting, personal hygiene. Why ADL waivers can be more flexible. Many people needing care prefer home health care, assisted living support, remaining at home instead of entering a nursing facility. Because of this, ADL-based waivers may provide broader access compared to nursing home-only provisions. Simple example. If a client cannot perform 2 out of 6 ADLs, qualifies under the contract terms, they may gain access to funds without surrender penalties, even if they remain at home receiving care. Important clarification. These waiver provisions usually remove surrender charges, but do not automatically withdraw money from the annuity. Clients still choose whether to take withdrawals, how much to access, when to use the funds. Understanding qualified care facilities. Not every senior living facility qualifies under annuity contract definitions. Some contracts require state-licensed nursing facilities, specific medical care standards, defined long-term care qualifications. It's important to review contract language carefully, carrier definitions, eligibility requirements with clients. Key takeaways. Future income guarantees are based on current interest rate assumptions. Higher future rates may create better income opportunities later. Care waivers can provide access to funds without surrender penalties. ADL-based waivers may offer more flexibility than nursing home-only clauses. Always review contract definitions and eligibility requirements carefully. Terminal illness waivers and client conversations about FIAs. Terminal illness waiver. Most fixed index annuities include a terminal illness waiver feature. This provision may allow clients to access funds without surrender charges if a doctor certifies a limited life expectancy. How it works. Typically, the insurance company requires a physician's statement or company form, a prognosis showing the client has approximately 12 months or less to live. Important difference. The carrier usually requires a prognosis, expected life expectancy, not simply a medical diagnosis. Once approved, surrender penalties may be waived. The client can access available funds without surrender charges. Important clarification. The waiver removes surrender charges, but does not automatically withdraw funds. Clients must still submit withdrawal requests, complete the proper paperwork, choose how much money to access. How to explain FIAs to clients. Many FIA clients are nearing retirement, concerned about market volatility, looking for more protection than traditional market investments. These clients may have experienced market downturns in 2001 to 2002, the 2008 financial crisis, significant retirement account fluctuations. Because of this, FIAs are often positioned as a balance between growth opportunity, principal protection. Simple client conversation example, question-based approach. You might ask, how would you feel if your retirement portfolio lost 20% in a market downturn? Most clients respond that they would feel uncomfortable or concerned. Then you can explain, what if you had an option that allowed you to participate in market growth opportunities while protecting you from market losses? Simple FIA positioning statement. A fixed index annuity gives clients the opportunity for market linked growth without direct exposure to market losses. You can also explain clients may earn better returns than traditional fixed interest accounts while avoiding direct downside market risk. Long-term averages may provide moderate, steady growth potential over time. Key takeaways. Terminal illness waivers may remove surrender penalties. A medical prognosis is usually required. Waivers do not automatically distribute funds. FIAs are commonly used for clients seeking growth with protection. Question-based conversations help clients understand market risk and retirement concerns.
Simple and professional FIA client presentation script. Starting the conversation. Would it be attractive to you if you could participate in market growth opportunities without taking direct market losses? Most clients will say yes. Then continue with, let me show you what I'm talking about. It's called a fixed index annuity. Have you heard of those before? In many cases, clients are unfamiliar with FIAs, which creates an opportunity for education and guidance. Simple FIA explanation. A fixed index annuity is designed to allow your money to grow when the market performs well, while protecting you during market downturns. Simple example. If the market gains 20%, the annuity may credit a portion of that gain, depending on the strategy. If the market declines 20%, the annuity is typically credited 0%, not a loss. Key client benefit. Over time, the goal is to provide steady growth potential while helping protect retirement savings from major market losses. This approach often appeals to clients who want less market risk, are approaching retirement, prefer protection with moderate growth potential. Keeping the conversation simple. Clients usually do not need every technical detail in the first conversation. Focus on the major concepts: protection from losses, opportunity for growth, long-term retirement stability, reduced market volatility. Simple explanations often create better understanding and confidence. Discussing income riders. If a client asks about guaranteed future income, you can explain, there are optional income features that can guarantee future income payments, but they usually come with additional costs. Then offer two approaches. Option 1. Add an income rider today. Guarantee future income amounts now. Option 2. Focus on long-term accumulation first. Review income options later. Choose the best payout strategy closer to retirement. Simple income rider conversation. If we avoid extra rider costs today, your accumulation value may grow more over time. Then later, we can review the best income options available for your situation. This helps clients understand the trade-off between guarantees today, flexibility and accumulation later. Key takeaways. FIAs help clients participate in market upside with downside protection. Clients are protected from direct market losses. Simple conversations build stronger client understanding. Income riders provide guarantees but may reduce long-term accumulation. Many retirement strategies focus on growth first and income planning later. Closing question. Does this sound like the type of retirement strategy that could help you feel more comfortable about protecting your future savings?